Is this the ultimate precious metals bottom indicator? No investors paid any attention. Central banks around the world just made a monumental statement, purchasing a record amount of gold this past quarter. Central banks purchased 400 tons of gold in Q3 and brought total purchases year to date to 673 tons. Purchases of that size haven't been seen since 1967, and the largest this decade, with the final quarter yet to go. That's the chart you're looking at right now, the central bank gold bullion demand. And this does not include any reported purchases from two normally large gold buyers, Russia and China. Turkey, Russia, India, and China have the largest buyers of gold over the past 3 years, hoarding over 20 million ounces. With gold up 5% the past week and holding above $1,700 per ounce, many gold stocks have seen sharp double-digit gains. Let's take a look if the bottom is in. The big Fed question. Given the transparent guidance from the US Federal Reserve, it is almost certain that interest rates will move a bit higher. Higher interest rates in developed nations like the US traditionally strengthen a nation's currency, because foreigners will swap their local currency for dollars to earn higher interest rates. A strong dollar is a headwind for gold price in US dollars and a tailwind for gold priced in your local currency market. Again, based off of the Fed's guidance, I believe rates will stay elevated for a bit longer. This puts a headwind on gold priced in US dollars over the next 6 to 12, 24 months perhaps. This could be why foreign central banks are purchasing gold in record numbers. Now, this could all change overnight if there's a 180-degree shift in economic policy from the Fed. But I don't see the Fed doing any pivot by year end. However, even with all the negativity surrounding it, gold emerged as a decent investment on relative terms. The chart you're looking at right now shows the year-to-date total returns for all major asset classes. As you can see, the broad basket commodities, mainly held by oil, is outperforming gold, US high yields, European high yields, and the Nasdaq being the worst performer. Outside of the commodities basket, which is a large part, as I said, to oil, gold is held in well relative to the other asset classes, which are down considerably more, hence the term relative performance. Gold denominated in foreign currencies has proved to be a safe bet and is up year to date in many currencies. But to confirm, just so you know, a true bull market in gold is only in full swing when the price of gold is going up in all currencies, including the US dollar. And that's the chart you're looking at right now. Until the US dollar price in gold turns green, we're not in a true full swing gold bull market. But what is the ultimate precious metals bottom indicator? Gold producers have fared far worse than bullion. On average, gold producers are down about 25% or more year to date. One of my sector health gauges for precious metals is looking at cash as a percentage of market cap. This measures the percentage of the company's value backed by cash in US dollars relative to the amount of value the market is placing on the company's assets. When times are good, cash will be in a very small portion of the company's valuation. When times are bad, cash will make up a higher percentage of a company's valuation. And remember, we're entering asset write-downs where companies are going to have to write down the values of their assets from a tax perspective. As you can see in the next chart that you're looking at, the ratio has crept up. Surpassed the recent 2018 high of cash to market cap. This means that on average, more than 12.5% of the gold producer sector's valuation is backed by cash in US dollars. For comparison, in December of 2019, roughly 5% of the value was backed by US dollars in cash. That's the chart you're looking at. The gold bargain bin. Share prices of gold miners have declined, but valuations are still not at bargain bin levels. The next chart you're looking at shows the price to cash flow estimate for the next year for a group of large gold producers. You can see that the 10-year average is about 6.58. The sample average that we've taken for next year is going to be about 5.35, but you can see the range is anywhere from 2 times to about 8 times. This is a good sign for value investors, but what we are looking for is a move below 5 times, which we believe will arrive. Under 4x would represent the most undervalued gold producers would be over the past decade. I believe we will continue to see trading multiples compress further as cash flow forecasts are readjusted lower. Remember crossflation that I discussed in my book. Even if I miss the bottoms, we track the financials close enough that we'll catch the uptrend if it starts taking off. Never try to catch a falling knife. I am not confident enough to try and call a bottom. Anyone who does is a fool. And I think with the headwinds we see ahead, we are confident we have time to slowly build our positions using our tranche methodology. But here's another bottom indicator chart. One of the key drivers in revised cash flow forecasts will be because of higher operational costs. After managing to keep costs in line from 2014 to 2020, because of the cost overruns from 2011 to 2013, a rising gold price coupled with inflation paved the way for a large spike in operating cash costs. Look at this chart right now. You've seen that the price to produce is over doubled in the last 15 years. The chart shows that cash costs vaulting higher significantly over the last 24 months. On a mine-by-mine basis, on a producing basis, it's possible to reduce operational costs by improving efficiencies. But as you can see in the chart, it's rare for the whole sector to be able to claw back a substantial portion of any large increase in production costs. What does this mean? It means that these new elevated costs of production, for the most part, are here to stay. And the parting thoughts of the week, I don't know when the exact bottom will be, and I never try to catch a falling knife. Once the rug gets pulled and the financial capitulation happens, and I suspect we're close, I'll be ready to jump on the best companies in the safest jurisdictions with the largest margins, like an alligator. The central bank's gold buying activity, the precious metals company valuations at multi-year lows, corporate cash levels at multi-year highs, all the indicators are signaling a warning that we're getting to the good part. These are the types of bargains I live for in this market. There are amazing deals to be had, but fortune only favors the bold and well-prepared. These are times to batten down the hatches, make an alligator plan, and prepare for the time to strike. And when I'm pulling the trigger to my own companies on my radar, you will find out through the KRO, and you will see exactly where I'm putting my money in this bear market. Stay safe. Subscribe to the KRO, which is a Katusa Resource Opportunities, to find out exactly what prices I'm buying at and what price I sell at before the trade occurs. And you get to sell before I do. If you want to give your portfolio an edge, consider becoming a member and giving it a try for yourself.